Hello, everyone. It's Larry Kotlikoff back with Economics Matters. My special guest today is Jonathan Treussard from Treussard Capital Management LLC. Jonathan is on for the second time on our podcast. He's going to kind of talk through different scenarios for 2024 and what was surprising about 2023 on the economic front, and think about all this connects to markets and your investments and to the economy's performance and your job prospects, at least our national job prospects. So we're going to have a very interesting presentation from Jonathan, in large part based on a slide deck that he's prepared for today. But I want to give you a little bit of his background. And Jonathan, I'm very proud to say, was my grad student, as well as a grad student at Viebody, and yeah, he had other advisors, but we certainly are very proud of Jonathan as a Boston University Ph.D. in economics grad student. I would rank Jonathan. I've had a zillion grad students over the years, and certainly Jonathan is among the top 5 in terms of mathematical abilities. He's the top one. He surpassed everybody on the faculty in terms of his mathematical skills, and his ability to handle mathematical finance. Jonathan's, so as I said, he's the founder of Treussard Capital Management. It's a registered investment advisory, operates as a fiduciary for its clients. He's had a lot of academic experience, got a great pedigree, practical experience. If you look at the prior podcast, you'll get a longer intro into Jonathan's pretty interesting evolution from running away from home in Paris at like age 17 to busing on the streets of LA playing guitar, to going to Santa Monica Junior College, to getting into UCLA, to excelling, to getting into the PhD program at Boston University. And then he worked for the Ziff family in New York on the risk management team, helping. This is a very well-to-do, well-off family that has a lot of money that has to be handled. And he then started working and worked for many years at Research Associates, a $150 billion quantitative global asset management manager. He served as partner and head of product, driving the firm's product strategy across all asset classes and across the globe. Before that, he worked as a senior vice president for the Irvine Company's investment fund in Newport Beach, California. So that's where he currently hangs out. Again, he has a PhD from Boston University and a BA in economics and international study from UCLA, graduated summa cum laude with honors in college, and he's taught investment courses at MIT, and he worked as a research assistant for Nobel Prize winning economist and finance expert Bob Merton. You can't get a better education in finance than at the hands of Bob Merton. Paul Samuelson referred to Merton as the Isaac Newton of finance. So Jonathan's the author of numerous articles and has a lot of media exposure. I think what you'll see and what you saw before is that Jonathan has a rare ability to translate difficult, complex concepts into everyday language, and to convey the economics of what we're talking about. So Jonathan, welcome, and
Thank you.
let's have you tell us about, ask the question, are we ready for 2024?
Yeah,
So,
I'm not sure that anybody's ready, but thank you, Larry. And first and foremost, I have 2 things. One is I promise this will not be a math class, despite your describing me as a math guy. So definitely stay tuned for non-mathy talk. And to everything you described about my past, none of it is possible without people like you, people like Tzvi Bodie, people like Earl Thompson at UCLA. So I just want you to know that your mentorship is a gift, that pays long dividends every day. So anyway,
Thank you.
uh, but yeah, I've been talking to a number of groups about 2024 and how to think about the world that we're facing, the world that we're entering. And what's interesting is whenever we talk about being a fairly skilled, a successful investor, people very quickly describe such people as seeing around corners. And of course, the idea is something related to predicting the future. And of course, there is no such thing as seeing around corners. Physics will tell you that the angle is the angle, and it's going to be really hard to bend light beams when you feel like it. But instead, what we can do is prepare and think long and hard about the scenarios that we might be facing. Number one, and two, adopt procedures and an institutional structure that would allow you to actually respond quickly. So again, as I think about 2024. And sadly, the parallel is relevant given the amount of geopolitical tensions we're seeing around the world. If you think about urban warfare and the idea of military personnel actually turning corners behind enemy lines, preparation and kind of preconditioning responses is probably the way to best think about that. But look, if we're lucky in the business that I'm in, investing, wealth management, and just to touch on that, Treussard Capital Management really is the sum total of my experience and my education for the benefit of clients in wealth management. And if you ask me, who my clients are, I think they have three distinguishing attributes. One is they actually want an investment professional, not a relationship manager. So if you're looking for, a steak dinner and a golf outing, I'm sure somebody else can do better than I, but I've been in the business of investing for 20 years. Number two, as you said, I act as a fiduciary, and so a huge part of it is I'm going to be on your side of the table, and that's something that my clients want. And three, someone who's going to empower, you with knowledge, and I think that's what today's about is just sharing my perspective. If I want to get cute, for what it's worth, I tell people that I help people and organizations escape the wealth management industrial complex, but that's for the laugh track. But anyway, again, as an investor, there's this kind of virtuous cycle, which is basically you get to do this long enough, you get experience. Hopefully, you're open-minded and you're curious, and you just kind of repeat the exercise. So, why am I not super excited about one and done predictions? Because being a prediction jockey is kind of a setup for disappointment. We were promised a recession in 2023. We were promised an inflation price wage doom loop, and we were told that we probably should be going down the path of T-bill and chill because the stock market was due for a massive decline.
Yeah, we had Jamie Dimon in June, and Larry Summers predicting. Well, Jamie Dimon said there's going to be basically a tsunami or
Yeah.
that's coming, and they asked him, well, when and how big? He said, well, I don't know, but it's coming. And then we had people from Goldman Sachs in the fall saying the same, not quite those words, but and then Larry Summers, the former Treasury Secretary, piping in. I wonder whether you have, and then quickly switching angles, but not necessarily saying, hey, I was wrong, don't listen to me again. It's rather, well, listen to this part of me, this version of me, not the old version of me. It's like, I remember Ed Leamer at UCLA said that a good way to become a successful investment advisor is to send like a $500,000 prescription prognoses out by, let's say, by mail, tell half the people the market's going to fail. The other half, it's going to succeed. The ones you get the right, send the right card to,
Yeah.
then that group, again, the next month you send out another, up and down set of cards, and you keep going with a winning set of cards. And by the end of a couple of years, people believe you're, the Oracle of Delphi, and now you've got a client set. And I don't know if you
Yeah,
ever
no, I know. I love that the one of the things that people talk about is and again, this is a different business from the business I'm in. I'm assisting clients one portfolio at a time. But in the asset management world, we often talk about the fact that firms actually will start, 10 strategies, incubate them in-house because they know that after 3 years, at least one of them is going to have a decent track record they can sell. And so it's the same idea. You may not be selling may not be mailing out the postcards, but you're cooking a bunch of meals in the back room and hoping that one of them, tastes half decent. So that's absolutely right.
And the point is, this is all random. That eventually, one of these things, one of these is going to pay off by random luck, but that doesn't mean they're going to pay off in the future.
Right.
So,
No,
but meanwhile, you've got your clients, but
yeah,
paying for your lunch.
that's
Uh,
right.
yeah.
But yeah, no. So I mean, obviously, as we just discussed, predictions at a rough go last year. Instead, what do we get? We got an economy that was, shockingly strong. GDP, obviously, GDP numbers have been updated now since Q3, but the U.S. economy has probably grown by some version of what, $650 billion in real terms last year. And we've produced, some version of 2 million jobs, which is not consistent with whatever Jamie Dimon described, even though, again, he's arguably one of the smartest and even perhaps more objectively one of the best informed humans there is on the economy. We know the stock market went up a huge amount last year. And importantly, in liquid markets anyway, it was kind of hard to lose money. If you look at 2023, the only kind of main asset class that actually managed to lose money was Chinese equities. And again, that's kind of a funny thing because we walked into 2023 with the assumption that China was going to show us how to do post-COVID. And of course, their economy is really struggling, and their stock market has managed to erase, what, some version of $6 trillion. So, so much for predictions.
And Japanese equities, this suggests that 20% increase in, that's given that from like the late 80s to for the next 30 years, the Japanese market never rebounded. Everybody
Yeah,
says that the stock market is a sure bet over the long term. Stocks are safe for the long term. And of course, Svi Bodhi, your mentor and father-in-law and my close colleague and friend forever, has been arguing that stocks are not safe for the long run, especially if you're taking money out through time and you're
yeah.
suffering this sequence of return risk. Anyway, go ahead.
No, and that's exactly right. And again, by the way, if you look at the longer term, and obviously we're barely looking at 10 years, this doesn't even qualify as long term, but the annualized figures on the right, U.S. equities did extraordinarily well relative to just about everything else over that course of time, and some people might conclude that that's all the proof they needed, when of course we know that in the best of cases, that's not something you should kind of project forward. And in the worst of cases, what this might be evidence of is really stretched valuations on the back of a handful of companies in U.S. tech.
So,
Um,
by the way, just back on that
yeah,
slide, the annualized is that like the average across the
correct,
two, the
correct.
decade? I
Yeah.
see. And and this is all in real terms, right?
No, this is nominal.
Nominal. So
Yeah,
real terms, it might be a little bit lower, a little bit different,
correct,
especially
correct,
with debt, because
correct.
debt could have been actually a negative given the inflation we've just experienced, right?
Yeah.
Yeah.
absolutely right.
Okay.
Speaking of inflation, again, I mean, it's we actually probably got our closest version of an immaculate disinflation last year, with PCE inflation coming down to, something that feels a lot more manageable, obviously, and as far as the person on the street, even gas prices coming down from where they were not so long ago, but ultimately, and again, to get to the stuff that really matters. This chart, in my opinion, tells us a lot about how to think about the world today. Three snapshots of the yield curve, in green, where we started 2023, in dark black, where we ended 2023, and in salmon, where we were at the end of September. And what do we see? We see that basically the market-driven rates, 1-year Treasury rates and beyond, ended the year right about where they started.
So if,
The
yeah.
yeah,
So
the
just
huge
define,
distinction is the
just
short end
define
of it,
these, Jonathan, if you could just define. So the green curve exactly is telling us what?
where the yield curve was on January 3rd of 2023.
Okay. So that's just like yesterday.
No,
And
this is a year ago. This is
oh, a
this
year
is
ago,
correct.
okay. And where it is today, uh, is like the black
Correct.
curve.
Correct.
And,
And
where, what
salmon was kind of the
middle,
peak of the yield rising ish in the fall.
right?
And so
So,
what's really interesting is, again, kind of the long market rates are basically where are back to where they started the year. Obviously, the shorter end of the curve, largely policy driven, are much higher. And so two things, worth noting on this. If you think about some of the stress we experienced last year, importantly, in the banking system, the picture doesn't look better today than it did a year ago. In fact, arguably, it looks worse because their funding cost is higher than where it was back at the beginning of 2023. But fortunately, long rates came down in the last quarter of the year. I hesitate to even think about what the world would have looked like stepping into 2024 if the long rates, if the 20-year rate was still at 5% today.
right.
So yeah, so that's where we are. And if you think about the major surprises that we experienced in 2023, I think number one is the residential real estate market being as strong as it turned out to be. As we know, even Jay Powell went out of his way in mid 2022 to encourage young households to not buy a house just yet, just in case the prices came down. And of course, that didn't bear out. Um, Second surprise, and this is something that you and I have talked about before on this podcast, is financial stress. It is surprising that after the bankruptcy of Silicon Valley Bank and First Republic, ultimately all we had was a little blip along the way when it came to financial stress. And of course, we know what the answer to that conundrum is. It's the fact that the Fed kind of jumped in and helped by basically subsidizing the banking system through the better part of 2023, telling regional banks, they could turn in their bonds, pretend that they were worth par when they were probably worth 80 cents on the dollar. And by the way, pay a funding cost of below what they could earn on deposited balances. So it begs the question, what happens to this graph as we proceed into 2024, as some of these facilities that were put in place are wound down later this spring. And then the last one, which I think is, again, as you and I are actual economists when we don't talk about markets, and I think this one is just unequivocally good news. We actually saw a jump up in productivity in 2023. And while we know that this, productivity is incredibly volatile, and so we have to see more of it for it to be convincing, um, productivity is obviously the secret sauce to economic growth. And so if we actually see productivity, output per hour improve, particularly after the kind of the horrific readings that we saw in the kind of retooling post COVID. That would be really good news for the economy, for the U.S. economy and the global economy. There was this period of productivity growth in the mid 90s to mid 2000s. And then we've been kind of stuck in neutral for a long time. So it'd be good to get productivity back up. So these to me were the surprises. Go ahead.
Yeah, I was just gonna say, so we're now heading to about 2.5% real wage growth. That's, productivity should translate into real wages. So
Mhm.
that's good news for I guess Biden, if he can convey it. Uh, the uh, the big run up, a lot of this is compositional too. I think we should point out that when you have, for example, COVID hit, we had firms laying off their least productive workers, retaining their most productive. So the average productivity goes up, even though
Yeah.
fundamentally there's still people out there who are equally productive.
I think that's right. I mean, the huge spike you see right at the beginning of COVID is basically companies going quote unquote more efficient, which is code for laying people off. And the huge decline we saw afterwards, of course, is a lot of people taking jobs that honestly they weren't trained to do. My view is the fact that 2023 had decent productivity growth is the people that were hired to work in restaurants finally figured out how to cook the meals, and the people that were put in offices, finally figured out where the copy machine was. So that's great. But let's see if it continues. But yeah, I'm an economist. People like to make fun of us, as you know, Larry. But I really think of myself as a financial economist. Which means I think about risk. I think about risk all day long. And you mentioned Bob Merton in your intro. Bob has this fantastic saying about focusing, leaning into what he calls long shelf life models. Models that are simple, but they have the distinct advantage of having long shelf life. Um, my best version of that when it comes to thinking about the future is, look, for anything you care about, just make three buckets: a really bad scenario, a middle scenario, which I call another day at the office, and a very good scenario. By the way, another day at the office is most days, and I don't need to ever hear that the S&P was up, 3/4 of a basis point today. That's not news, and it's not relevant. But once you have the three scenarios, the three buckets, figure out what they look like and figure out what the odds of those buckets are. And, kind of if you think about decision making under uncertainty, which is what this is about, a pretty decent heuristic for a good decision is simple. It's a decision that doesn't look silly in the most likely scenario. Nobody wants to look silly when the obvious happens. Which is why people that are perma bears and perma bulls end up looking silly. You can't just always say the same thing. Make decisions that don't look naive in the second most likely scenario. That's literally the difference between being an amateur and a professional. And of course, that decisions that don't blow you up in the least likely scenario. And that's the definition of risk management. So that's my model for today. That's my model. So as you can tell, not overly mathematical, despite my reputation. But it's a very sensible way to think about the future. And with that, I'm excited to actually start talking about 2024. And you and I think you know Allison. I know Allison Schrager. She's now a columnist at Bloomberg. She's a really solid thinker, and she recently put out this column, suggesting that 2024 is the year the economy will stop being weird. And I hope she's right, but I put a question mark at the end because we've been handed a lot of weird recently, and I guess it could kind of go on. But given the model that I just laid out, despite the historical record suggesting that the soft landing is, on an unconditional basis, very unlikely, it seems like we might actually be getting it And in a weird way, I think we should be cheering for that. I think that'd be fabulous if we did. Including because I'm not in the business of hoping for bad things for our civil servants, the good people at the Fed, and I'm certainly not in the business of hoping for bad things for the U.S. economy. But let's remember that the soft landing is one in which growth would be slower. It's not a bonanza of an economy. It's one in which labor gets a little bit less comfortable. It means we were just talking about wage growth. Wage growth probably is declining, and unemployment is probably ticking up. And if we see inflation continue to decline, we should expect it to decline slowly and with a good amount of volatility. One of the things that we know from looking at empirical data is high volatility regimes, environments are also high inflation volatility regimes. So high inflation comes along with high inflation volatility. But if we get the soft landing, it's the good news is we're probably going to see a little bit more residential activity and mortgage activity. Honestly, to me, the good news in that isn't that the prices are going to stay where they are. It's that we're probably going to figure out finally what residential real estate is worth, because I'm not convinced the prices we saw last year were all that representative. The more ambiguous part of the picture is commercial real estate. I'm not convinced that a soft landing scenario is one in which commercial real estate heals. Hopefully we get enough time for people to make provisions for where the real prices are when it comes to office space and the rest of the
So you have on the residential real estate, the fact that prices have kind of not plunged, given that mortgage rates got up to
8 at the top.
8 at the top, and they're still close to 7. I take it. It's remarkable that the prices. I mean, maybe it's just such a thin market. Nobody's buying and nobody's selling, so that the data are in some ways misleading. That if this
Kind of
continues,
frozen in time a little bit.
yeah. And then on the commercial real estate, you have markets like San Francisco, where I understand the vacancy rates like 50%, or maybe that's Chicago. I've heard Chicago is just awful too on vacancies.
Yeah.
And then there's also the banks owning a lot of commercial real estate, especially I think mid-sized banks owning in the
Regional
sense,
banks.
say regional banks, yeah, that not owning in the sense of owning the buildings, but owning the debt, that they've made the loans, and then they're making loans to subsidiaries of companies, development companies that can go bankrupt, and then you can't go after the headquarters because they're a sub and they're a separate entity. So if you're a regional bank, it's you own it, and you end up taking over the building that's half empty. And then the question is, I've seen studies which suggest that if valuations go down like by 10% of these commercial properties, that you have a good chunk of the regional banks going, being mark to market underwater,
Yeah.
negative, bankrupt, which
Yeah.
brings us back to the prospect for banking crisis. I know the Fed is pretty good in convincing people that they can put out brush fires, but when it becomes a what's the other word? I guess conflagration that takes over the entire region. We're in a different world of hurt.
I think that's right. And so that takes me to the second scenario, which is basically the one you're starting to spell out. Look, if and it doesn't take a lot, but if we do get more of a slowdown, and it might just be kind of a return to companies seeking efficiency. By the way, one of the things that is worth talking about on the commercial real estate side of things, is the fiscal part of it. With these empty office towers in kind of downtowns all over the nation, tax receipts can quickly be down. Um, yes, the regional banks might be kind of doing the old extend and pretend or whatever they call it now. I think it's pray and delay is the new expression. But there's a lot of praying and a lot of delaying in the system. If tax receipts come down, that might get pretty ugly. But yeah,
Yeah.
look, if we get anything that trips up the soft landing, it probably looks like a harder landing, and it's one in which people lose jobs. And if you don't have a job, you're probably going to be paying your credit card bill and you're probably going to be paying your mortgage before you go out for dinner. And we know where that takes us. And it's a world in which the banks, keep tight. It's a world in which, commercial real estate, trouble spills out. And I think it's finally a world in which, residential real estate, moves in the same direction as the rest of the real estate stack. And that's
Right.
down.
It's probably about 10% of the workforce, maybe work for state and local government is my guess.
Yeah. Yeah.
So I don't know, but
Yeah. And look, there's a distinct possibility that we should be on the lookout for a reacceleration. Again, I don't want to be I don't want to be, and I'm not a doomsday person. It is possible that productivity growth and the jobs that we've created can generate a virtuous cycle when it comes to the U.S. consumer. It is distinctly possible that we figure out a way to stimulate ourselves a little bit more. And I don't care if you're China or if you're, the U.S. Congress, if it becomes politically expedient, I would not be surprised if we saw more fiscal stimulus. Whether or not that's a good idea is a whole other conversation. But
yeah,
I'm
let me just raise this issue with you. Maybe it's the least likely, maybe it's more likely. I mean, we had 3 American soldiers killed yesterday by
yeah,
Iranian backed agents, and uh, if we attack tomorrow, if tonight we attack Iranian facilities, maybe in the Gulf or maybe in the mainland, and they start sending missiles at
yeah.
Saudi Arabia's storage tanks of oil, like they did before, where nobody ever responded to that, which I found remarkable. Uh, the price of oil is going to presumably shoot up overnight. And now we're in a different world when it comes to inflation
I think
and
that's exactly
interest
right.
rates. Yeah.
I think that's exactly right. I mean, and again, I'll skip over a couple of things, but by the way, this is my interpretation of a lot of what we're discussing, which is it doesn't take a lot for the power of stupid people to manifest itself in the world.
And by stupid
Um,
people, we're talking about some of the, you know,
yeah,
it's the
but
Ayatollah or Putin.
but yeah, I mean, again, I think to cut to the chase, I think geopolitics, and particularly the prospect of broader conflict is unequivocally, the scariest thing we're facing this year. And you just talked about 2 things that are critical. I think one is kind of the inflation, pathway, and that's kind of the most easy to understand, but also the least worrisome. Yes, we know that we could easily see inflation spike if this continues. The chart on the left is showing you the cost of transit of goods, and you can see how it's rapidly come up recently, given what's going on with the Red Sea and so on and so forth. So yeah, you could see oil spike, and you see the cost of moving things around the world go up. But nothing compares to what hot war would actually bring upon us. And by the way, again, I don't think the Taiwan War scenario is the more likely of the scary scenarios we're facing. My hope is China is a more rational actor than Russia or Iran. But to your point, when the missiles start flying, that's been a guaranteed recipe, not only for human suffering, but for inflation, for as long as humans have been going at it in this regard. But to go back to a couple of things that you started to talk about, um, I'm just gonna highlight this. one is the U.S. consumer is hating this Goldilocks economy. So, that clearly has one political implications, but importantly, it's telling you something about where the households are. Um, they're facing trade-offs in the background that may not be obvious to us otherwise. But the one that, really to me is concerning is a return to stress in the financial system. A couple of data points here. I don't think, repo market trouble is as likely today as it was in 2019. But count me as one who's on the lookout for what I call Bankalooza. I think SVB redux is absolutely possible. The savings and loans crisis teaches us a lot about forbearance, and right now it looks like forbearance has quote unquote worked. Um, but will it? I'm not convinced. And we know right now that the economics of regional banking are upside down. Banks are telling you that that's the case by tightening, lending standards. But it's not clear how we get out from under a proper mark-to-market event on the balance sheets of the
Right, and the
banks.
regional banks are, as I understand it, issuing, borrowing money at a much higher rate. It sounds like the S&L crisis, which lasted for 9 years, it was a
Yeah.
slow torture rather than rapid torture, financial so where they're borrowing at a high rate because and then they're put it at high risk to, you know, I think is in effect to hit a certain number on the roulette wheel, whatever, uh, and save themselves. But because, if you're in a situation where just doing the same old means you're going for good, but you can borrow to put it all on red 43, uh, you might as well put it on red 43, right?
Yeah, and by the way, I think this has the way to think about that is extreme risk taking as becoming uh, uh, your last hope for survival. I think a lot about um, what I would describe almost as career management in the financial services and in banking. And again, no one's going to put themselves out of business. That's, so there's the last ditch hope, right? It's like whatever that cheap movie where, you can't pay the rent, but you go to Vegas to bet the last $100 you got in your pocket to see if you can just finally make it. I think there's a lot of that going on. And to backtrack a little bit, I worry about it when it comes to the pricing of risky assets in general. And this has implications for risk taking the way you're describing it, which is, taking, high flying risk, hoping that you hit, the roulette table just the way you want. But the reality of it is, if you look at implied volatilities on equity indices, implied volatility has been very low relative to historical standards. That's number one, and the spread on risky credit has been low as well. And that, again, it's interesting because in 2023, last year, public markets were fairly tight when it came to credit spreads, and private markets were pretty wide because people were getting ready for, more trouble. And what we're seeing now is the direction of travel being in private markets, actually getting tighter on the credit spreads because people are hoping that the worst is behind them. But my anticipation, again, going back to the kind of the three scenario kind of mental model, the most likely is certainly a tick up in volatility. It's hard to see how we stay in this very low volatility environment for much longer. And if we do get the soft landing, then hopefully it's equity volatility going up a little bit, credit spreads widening a little bit, things being a little bit more attractive across the spectrum of fixed income beyond T-bills. But the concern, of course, is if we hit anything that resembles a harder landing, You could easily see VIX, top 40. You could easily see credit spreads blow out. And yeah, that might prove out to be the land of opportunities for people that have the demeanor necessary to invest in a crisis. But it could get dicey. It could get interesting. And honestly, as worried as I am about a real stress test, if you will, I'm almost more worried about what happens if risk plays dead for a lot longer, because when volatility is subdued, people start doing things that are not economically motivated. And again, I go back to this kind of career management concept. Um, it's really uncomfortable to tell your clients year after year, yeah, there wasn't a lot to do this year. And so people kind of go out on the risk, spectrum and so on and so forth, because what choice do they have? They have to show activity. But that's when, people position themselves in a really fragile way, which, again, kind of takes me back to this beautiful slide.
Yeah. So the I guess the question is does this all feel like 2007 where, everything's looking rosy and then, everything falls apart uh, pretty rapidly. So, well, I mean, you put out these three scenarios. Do you have a preferred scenario, or you put like equal weight
No,
on?
I do. I do. And again, as I made clear at the beginning, I look, it is very hard to predict what will happen. We know that. For what it's worth, I think 2008 seems unlikely. But it's worth considering. Again, I personally think we are in a decent place for, the soft landing, and we should, again, hope that that turns out to be the case. And it's worth highlighting the difference between analysis and hope. Um, it is very possible that we continue to see, an economy that defies, the stress that we throw at it, and kind of a normalization, a further normalization. However, if anything, goes sideways, I think we're, the prospects of a harder landing, are pretty decent. People talk about, are we back to the Roaring Twenties or something? I think that's a long shot. I think we have real issues to contend with that are going to come back to require some attention. I mean, think about again, even in a happy scenario, some version of $1 to $2 trillion of commercial real estate debt has to be refinanced,
Yeah, well,
over the next years.
right. So we got the commercial real estate. We've got whether housing prices will, mortgage rates are staying high because lenders don't want to get burned again by inflation. So that experience could keep rates high for quite a while. That could ultimately drop prices. The fiscal implications of the cities kind of emptying out.
Yeah.
We have, you got Ukraine, the Russians were to break through because, and the Republicans keep us from rearming Ukraine for much longer, and they're on the border with Poland, and maybe start moves. And then if Trump gets reelected and pulls out of NATO in effect, or
Yeah.
that's the reading. We have Europe that's basically disarmed. It seems all the production of military equipment seems to be happening in the U.S. Most of it, not all of it, but they're spending. If Germany's spending 2% of GDP on military, we were spending like 10% in 1950. In
Yeah.
in the middle of
Europe is not ready.
World War II, we were spending 25%,
Yeah.
and Germany's talking about it's going up to 2 or 2.5. There's just some lack of reality here. Putin won't, if he's given the green light, he'll move right into Finland, and uh, if Trump's elected, there's no, I don't think there's any reason to believe that he would actually defend Finland, to tell you the truth. I mean,
I don't recall him and Zelensky being particularly good pals.
no. And So then you've got Iran,
Yeah.
that could happen, unfold very quickly, and you've got the Houthis, are we going to be in a land war there in Yemen? And then there's still Gaza. And so a lot to be concerned about
Yeah.
in, in
I think
these
that's right.
supposedly good times. Uh, so I hope we didn't scare a lot of people today, but uh, there is a safe investment out there that's quite a decent one at the moment, which are inflation index bonds. 30-year tips are yielding like 2% real. That's the highest rate observed in decades. And the fact that they're so high is kind of indicative. If you go to svbody.com, you can see the latest values. I just looked today, again, 2.09. The fact that they're so high is kind of indicative of the fact that people might be overconfident in this market about the future, because uh, if you really thought things were risky and inflation
Bidding
was
them up.
risky, you'd be bidding, yeah, you'd be bidding up the price and the yield would be going down, but we're seeing the opposite. So,
Yeah.
um, yeah, there's a warning here in today's conversation. I want to thank you, Jonathan, so much for coming on to extend
Thank
that.
you.
I know it's not for sure warning, but the real issue is how you manage your portfolio in this period. Uh, Jonathan is certainly one great source for anyone who would like to talk to him about getting his services, procuring his services. But let me just also put in a plug for my company software, Maxify Planner. If you go and run the full risk investing and you run different scenarios about inflation, you can see what you might be facing into the future. Of course, we're not necessarily tracking in our in our simulations of the returns on the market assets. We're not conditioning on current events. We're just saying what's the long-term history of these securities performances. But certainly you can look at whether you're diversified enough so that the downside risk is limited to your living standard. Anyway, great to have you back, Jonathan. We're
Thank
going to
you.
get
Thanks
this
for
out
having me.
right away, and we'll get you back again soon again.
Sounds good. Thank you so much. And again, if anybody wants, to reach out, my email address is on the screen, jonathan@treussard.com, JONATHAN @TREUSSARD.com, and my phone number here as well. I will note, if you just go to my website, treussard.com, people live on a, range of desire to engage. I would love to talk to people who actually want to discuss their portfolio, and I would be thrilled to do that. But if all you want to do is subscribe to my newsletter, I love to, again, share my thoughts. I tend to not be a spammer. I limit myself to once or twice a month. And so go to my website and subscribe.
Great. Okay. Thanks again, Jonathan.
Thank you.